Mexico. If they do, it's a 20% tariff. We're still going to ship pork. It's not going to stop the market. It may dampen the prices a little bit. Canada has retaliation on U.S. pork today. Does Brazil retaliate? I think that's a non-issue. So what are the wins? Our Japanese beef tariffs are at 23% right now. We have a new agreement with Japan. They said we're going to zero, but there's no details yet on beef. I'm not sure beef will be at zero, but could we get a cut? It would be fantastic. It would put us at a huge advantage against Australia and other markets. These tariffs going on tomorrow, especially that Brazilian tariff, they're going to slow the flow of beef and pork imports, especially beef. This 90s price, 90% trim is record high. It's going higher tomorrow. It's probably already started. Note, we have the new access agreements with Philippines, Vietnam, UK, EU, Japan, Korea, and others. And those have happened very quickly. They're all what they call framework agreements. Unfortunately, we just don't have details. I don't know where we're at on agriculture, but hopefully we get some benefit out of all this, and we should expect that. So back to Brazil. Here's our beef imports. There's the imports, and there's the numbers for 2024. You can see Brazil, 700 million pounds last year. They're going to surpass that, or they were on track to surpass that this year. But what did those heavy tariffs do August 1st? They clobber Brazil. Now, this was unique. Trump put out a press release yesterday justifying his 50% tariffs on Brazil. And the reason he did that, legally, he could not impose tariffs on Brazil under his emergency declaration because Brazil has a trade surplus with America. They actually buy more from us than they export to us. And so he kind of had to come out with new justification. And he said it's about human rights violations. He just signed it yesterday. He said 50% on all Brazilian imports. That takes their beef now to 76.4 because we have a regular 26.4% on Brazilian beef. That beef trade's over. But what Trump did, he claimed this is over human rights violations because Lula da Silva is targeting former President Jair Bolsonaro and his supporters. And so Trump has jumped right into the middle of Brazilian politics and said, hey, you can't prosecute, you can't investigate the former president. That's a human rights abuse. And therefore, we're putting 50% tariffs on. Brazilian meat packers came out and said they're going to lose $1 billion this year due to those tariffs. I don't know if it's going to be quite $1 billion. They're still going to export that beef. It's going to go to China. It's going to go a little cheaper, but it is going to be painful. 90% trims in the U.S. We're at current record highs. This morning, we were $4.22 a pound. That's unbelievable. We're going higher, and that's because we're slowing the flow of these imports. And so who are the winners? Really, our industry wins because that tightens our market and sends our prices higher. But also Australia, New Zealand, Canada, those guys are going to be getting phone calls. And so the effect in Brazil, look at those cattle prices there in July in Brazil. Cattle prices drop. And on the chart on the right, this is Brazilian exports, the price per ton, US dollars per metric ton, when they export beef to China and the US. That 76.4% duty makes shipments to the US priced way below what they could do. That gives a spread now $4,000 a ton better to China than it is to send to the US. So those Brazilian shipments are going to stop. And the reality is, if we look at May, June exports out of Brazil, they kind of already have. I think they fully expected this to happen. They've already slowed the flow. But look at those big shipments in May. Unreal, right? And so, again, that tightens the 90s market. The 90s market is your coal cow prices. We'll talk more about where coal cows are headed, but prices are up. All right, let's shift and talk here just a little about the economy and about inflation. And if you look at the inflation, really what we're talking about, this is the economic consequence of $6 trillion of COVID money dumped into the US economy. And all we hear about in the news is, oh, inflation's falling, inflation rates are falling. Now think about that. Falling inflation rates do not mean that prices are declining. It means that they're rising at a lower rate. So if inflation's 2.3% like it was last month, the CPI is still record high. It's 2% above a year ago. And so unless the inflation goes negative, prices are still going up. And this is a big concern. Now, if you want to blame somebody, this is the best economic explanation I have for inflation. There's the COVID-19 wildfire. There's Congress flying over in a bomber jet and fire bomber. And out of the cockpit, there's two voices. That strange looking fire retardant. And the response is, it's money. And that's what happened with COVID. Congress did the only thing Congress could do, and that was spend all of our tax money in an absolutely insane, irresponsible way. Here's how insane and irresponsible that was. The US government increased our money supply 40% in 2 years. You think that's inflationary? Absolutely. That's why we're stuck. We don't go pull that money back out of the money supply. It'll be there forever. This is the new baseline. These new inflationary levels are here to stay. And when you get this sticky inflation, what that means, we have sticky interest rates. Because the Fed, to try to hold cash out of this inflationary fire here, they raise Fed funds rates. So you can put money in US Treasuries at 4.5% with zero risk. That takes billions out of the US economy and holds them there in Treasuries. You start cutting those interest rates, that cash comes washing back into the market, in commodities, in real estate, in equities, in everything. And so this game of interest rates is high pressure here. And if you look at the inflation outlook today, you really got to watch the Fed and their interest rates. Probably the worst job in the world today is Jerome Powell's job. He's the Fed chairman. This is a tweet by Charlie Bilello on Twitter. He has some great economic data. Stocks all-time high, home prices all-time high, Bitcoin all-time high, money supply all-time high, national debt all-time high, CPI inflation 4% a year since 2020, 2 times what the Fed's target rate was. And what's the result? The Fed is expected to cut rates 2 times this year. So there's Jerome Powell dumping money out of an airplane, right? If he cuts rates, that's what he's doing. He's going to cut rates and let cash wash in. And the risk of inflation going up is very high if we do anything aggressive in cutting rates. Those rates have been unchanged since December 2024. Yesterday, the Fed met and said, we're going to hold them for now. So we'll see. But Trump is leaning hard. Trump is just browbeating Powell, calling him too late, threatening to fire him, just clobbering Powell, saying, you have got to cut rates. And of course, Trump wants to see economic growth. But the reality is, cutting rates too quickly could be very, very dangerous for inflation. So this is a futures curve of what's expected for the federal funds rate. You can see us there at 4.3% in July. The futures curve expects that rate to be 1.3% lower by the end of next year. 2 cuts this year, 3 more in 2026. That would be aggressive. And I think to do that, we would have to see this economy slow down to be able to cut rates that quickly. But I'm telling you, the economy has not slowed down. And you guys are very well aware of it. Take a look at this inflation chart. This isn't a 1 year. Most inflation charts are 1 year saying, oh yeah, we're doing great compared to a year ago. Look back to 2020. Fed cattle are up 123% since the COVID year, 2020. Beef prices double. Hog prices 81%. Even chicken breasts up 64%. So in terms of U.S. meat and livestock, there's the revenue. That's what meat and livestock is selling. Here's what the meat and livestock producers are buying: corn, wheat, and soybeans. Those have not kept pace at all with meat. So what does that tell us about margins? Margins are fantastic in the production side. Everybody's making money except the corn farmers and the beef packers. And that's not going to change anytime soon, probably for either one of them. So we're in this unique world of high inflation. Now, what does this mean to the cattle and beef markets? You guys are aware, right? Fireworks, lights out. These markets are unbelievable. What I'm going to tell you today, and you won't believe me right now, I don't know if you will at the end, there's more to come. Global supplies are going to tighten. U.S. supplies are going to tighten. When supplies tighten, prices don't go down, they go up. So here's where we sit today. 550-pound steers are up $75 a hundredweight from a year ago. Now, I gave a lot of presentations a year ago in the cattle industry, and I told a lot of guys over the last year and a half, you're going to see calf prices in 25 up $45 a hundredweight. I missed that by $30, $75 a hundredweight. Look at fed cattle up $44 a hundredweight. We had actually forecast, you can go back on our podcast, we had forecast 230 fed cattle over a year and a half ago. We said that cattle price high, we're going to see fed cattle above 230. And 6 months ago, we were beating that drum. 8 months ago, when fed cattle were $2, $1.80. But this thing is for real. And as crazy as it sounds, I don't think it's over yet. So as a cattle rancher, you always ask this question. I go in the store and I see $18 ribeyes. I want that price. I'm the guy out here up at night and getting my boots dirty and calving cows in the snow, and the retailer sits over there doing nothing, and he's taking the big whack out of our value chain. So I prepared this slide when I talked to cattle groups to say, here's how you get a piece of that pie. Your 550-pound steer, if you run him, he's $2,000 today, $2,100. If you run him through a feedlot and put 90 bushels of corn in him, he's now worth $3,300. You want to cut his head off and put him in a box, he's now worth $5,128. You can add another $1,700. And if you want to find a way to direct market that thing to consumers, well, there's another $1,300. So that's how you get from your $2,100 calf to your $6,500 retail beef price. So there's potentially $4,400 in added value per head, per animal, to get that calf from your ranch onto the plate in front of a consumer. So here's my questions for you. 1, how hard do you want to work? 2, can you accept another 6 to 12 months of risk without payment? 3, do you enjoy online marketing? Which I know the answer to all of us is no, but do you have a daughter-in-law that does? Do you have a daughter that does? Does somebody love? Is there somebody in your family that can do that? Here's the 3 key challenges to an integrated system. And I've worked for a branded beef company trying to do this. 1, you go talk to a restaurant and say, hey, I raise great beef. They'll say, we'll take it. We'd love to have it. But they're going to say, we want steaks 12 months of the year. How many times do you wean calves a year? You got to figure out how to supply that stuff year round if you work with a retailer or a restaurant or something outside of individuals buying your beef. Second question, who's going to kill, cut, and wrap that beef? And I'm telling you, it is not cheap. Our locker plant here, you go get a beef killed here in Idaho and get your bill from the pack or from the plant there. They're going to charge you $600 to $900 to kill, cut, and wrap that thing. So that's a big hit. Carcass utilization. Everybody will want your steaks, but you got to find a way to move rounds. I know as a kid, we grew up killing and getting our own beef killed, and we'd put that beef in the freezer. And within a few months, all of the steaks are gone, and we're all digging through round steak, trying to find one more ribeye or T-bone in the bottom of the freezer. That's the same problem. You got to find a way to move all of the carcass, not just the steaks. So anyway, just thought that was kind of a side note that may be interesting when you go in the retail store and you go, good grief, why am I not getting these kind of prices? There's your explanation. And I say, if you can do it, go get it. Go get it. I know some guys over the last 3 and 4 years that are doing really well with this, but I'm telling you, you earn it. It takes some work. All right, over to the markets. One of the things that's most extraordinary about this market, the most important thing I'm going to tell you today is the next 3 slides. We have record high prices. What are our supplies? Record high. We virtually have record high prices at the same time that we have record high supplies. Look at 2015 on that chart. How did we get record high calf prices in 2015? We had a big drop in supplies. Well, production, you can see, has declined slightly, but with imports, we still have big supplies. This rally has been demand driven. Take a look at this chart. The blue bars are pounds per capita. That's how much meat for every man, woman, and child in America. The green line is the retail beef price. Look at what the last 6 years show. We've actually increased supplies through carcass weights, through the drought, pushing more females through the system. We just have kept pulling rabbits out of the hat. We've cut the herd 10% during those years, but we've somehow gotten more beef, bigger imports, bigger carcasses, more cattle through. And so what's crazy about this market, even with higher supplies, we have pushed this retail price up to $8.60 a pound. Here's what a normal cattle cycle looks like. Look at 2015. We cut 10 pounds per capita off that market. That's how we got those record high calf prices in 2015. We cut supplies. What's going on now? It's happening with bigger supplies. The only explanation is demand. Now, here's where this gets weird, and here's how you got to listen. You got to hear this and understand this to hear what I'm saying today. The next 2 years, we're going to see production drop simply based on 5 years of liquidation, heifer retention, cow retention. We drop another 5 pounds per capita off this market the next 2 years. Where do you think prices are going? When we cut supplies, prices don't go down, prices go up. And I know that's crazy. I know you look at these prices and go way too high. Retail's too high, consumers can't pay it, this is insane. But what I'm telling you, the dog is hitting the end of the chain, and I'm going to show you data to show that. We are going to cut supplies, which is going to push prices higher. And I have people tell me, well, this cattle cycle's different. It's not going to be the same as it was. This cattle cycle's different. The age of producers too high, interest rates are too high, land prices are too high. We're not going to have a cattle cycle. We aren't going to have a cattle cycle at $3 calves or at $3.50 calves, maybe not even at $4 calves, but what about $4.50 or $5 calves? Somewhere we're going to find that price needed to turn this cycle. And here's my evidence. This is 100 years of data, 105 years of data. There's the US beef herd, and take a look at that. Now, not every cycle is the same shape, but there's 100 years of cattle cycles. And you're telling me this time's going to be different. We're not going to rebuild this time. We've done it for 100 years, and we will take markets to the level they need to get to make this happen. And that's where we're headed today. So one indicator is cow slaughter. 2015, look at what cow slaughter did. When we hit rock bottom in the cow slaughter, that's when our prices are the highest. Now that drought pushed a lot of cows through the system in 22, 23. We still had a lot of cows coming in. But cow slaughter is now down 12% year to date. So what about our data? Last week, USDA released 2 reports, the cattle inventory and the cattle on feed. Did they show us much? Not much. The cattle inventory report showed that, the calf crop is 1.5% down, heifers down 2%, beef replacement heifers down 2.6%. But all of them were within 1% of estimates, pretty much, but no big story here. But what does this suggest for the rebuild? If we go look at the data from that report, and I want you to look at the top line. There's beef cows on this chart. That's the beef cow inventory. Now, this July report, there's been some years they didn't do it, and last year was one of them. 2024, this report got canceled because of funding. And so we have those gaps. So look at that drop. And if you look at 22 to 24 on the chart, you go, well, we're about stable there. Now, what I'm telling you, I think liquidation has ended. But has the rebuild begun? We don't have this inventory back to July, but we have one from January. There was a January cattle report that shows today we have 900,000 more beef cows than we did in January, and 900,000 fewer heifers. It looks to me like the last 6 months, we moved about 1 million head into the cow herd. And so that's what I think happened. That little V in the market right there, last year when we didn't get the report, I think that was the bottom. And I think we've started to tick higher. So with this report, we can calculate how many feeder cattle and calves are out there. This is the pool for feedlots to buy from. Take a look at that, 34 million head. That pool is shrinking. Look at 2014, 2015. The high in the cattle price was 2014-15. That's when that thing bottomed, and pretty soon it picked back up. Now realize this Mexican border has stalled a flow of 1.2 to 1.4 million head a year. That tightens this even further. And what does this mean for packers? There is no good news. I mean, packers have no way out of this. Sure, they can go close a plant. That may help them a little bit, but the reality is they'd have to close multiple plants to get their leverage back. And I don't know where that goes. I don't know if we see a plant close, but I don't think a plant closure tips this over anytime soon because the market is still tight. So the other report we got last week was cattle on feed. And there you can see the estimate versus actual. The big story there is placements. Placements were 6% below estimates. They were 8% below a year ago. This is what the market's been watching for. Live cattle futures have that negative curve. If you look at live cattle futures, every contract out in front is cheaper than today's price. Live cattle futures say we're going lower the next year. And the reason is people have been watching this going, when you show me lower placements, I'll go bid up the back end of that curve. I think it's just starting to happen. So here's what the inventory is. Look at that big drop in cattle on feed inventory. I think it's finally just beginning. Placements there, if you look at 24, 25, placements were down 123,000 head. Half of that was in Texas. That's screwworm, right? That's that Mexican border being closed. I don't think that border's opening anytime soon, and we'll talk about that towards the end today. Is this enough to shift live cattle sentiment? Maybe not on its own, but you watch these reports the next 2 or 3 months. If we continue to see those placements drop, that tells us retention's underway. Look out. Another indicator, the female ratio. What percent of our females are in the slaughter mix? And if you look at this chart, you can see we're not there yet. Now it's complicated. Drought complicates it, but look at those calf price highs. When this blue line gets down there to about 46%, that's when you get your calf price highs. We're not there yet, right? That blue line, that's a 21-month moving average. It actually did a little head fake this spring and dipped higher. But I think over the next 6 months, this thing's going to start to drop. And as we move into 2026, we're going to get right down into that 46% range. But I don't think it'll happen this year. Another indicator to watch, and these are key indicators because we all want to know when the rebuild begins. In retrospect, we always look in the rearview mirror and go, oh yeah, you can see exactly when it began. When it's happening, it's very hard to predict. And so that's why we watch these indicators so closely. Every quarter in the cattle on feed report, we get the heifer percent of cattle on feed. So that's what this chart looks like. And you can see there again, 2005, 2015, very clearly. When this thing bottoms, that's when you get your calf price highs. Well, April was 37.6. The July data that came out last week was 38.1. This thing ticked higher. And you go, wait a minute, just a little bit. You can see this thing's pretty choppy, right? I don't think it changes anything. But one thing you got to realize, what about the beef on dairy impact? You've all heard about what's going on in the dairy sector. The beef on dairy impact is important to understand, especially with this chart. A conventional dairy system, you start with 100 calves, half of them are steers, half of them are heifers. You pick your best 20 replacement heifers. You end up with 30 heifers on feed, 50 steers on feed. That's how a normal dairy system works. Well, how beef on dairy works, those 100 calves, you sex semen the best 20% of your cows and you get 20 replacement heifers. The other 80 cows, you AI, not with sex semen because it cuts your conception rate. You get 50-50 on the rest of the herd. So what that means, you end up with 60 heifers and 40 steers in the end. So what that does, it produces 33% more heifers in the dairy system, 20% fewer steers. This is a CoBank chart showing that influence. See how quick it happened just over the last 5 years? So if beef on dairy slaughters 2.4 million head and you get 33% more heifers, that's 400,000 more heifers divided by cattle on feed tells you we probably have 3% more heifers as a percent of cattle on feed than we have historically. So this chart, instead of 37, 38%, you back off 5%, and it's probably 34, 35% right now for comparison. That's important to understand. This is a little bit of a head fake. We think this thing's steeper than it is. We think we're further into this beginning of the rebuild than most people realize. And if we look at this same data and just look at year over year, the change year over year in that heifer percent of cattle on feed, look what's happened the last 2 years. It's happening, right? It's happening. We are seeing less heifers on feed. The drought pushed a lot of heifers into feedlots. The dog's about to hit the end of the chain. One other indicator. This is a pretty loud indicator. What's a bred heifer worth less a feeder heifer? 2025, $1,200. In 2015, when bred heifers were $500 over feeder heifers, we built so many, we turned the market over in a year. Those bred heifers are $1,200 higher right now. The market is screaming for more bred heifers. I was actually looking for some bred heifers this spring, and out here in Idaho, I mean, you could find them, but not at a price I'd pay for them. Good breeding heifers were at a huge premium this year. And I think that's indicative that the rebuild is just beginning here. So what does this look like? Here's the beef cow inventory, the blue line, and there's your calf prices. When does the high hit? If we look back in these last cattle cycles, the bottom of the cattle inventory, the next year was the high in the calf price. 04 was the bottom in the inventory, 05 was the higher calf price year. 14 was the bottom in the cow inventory, 15 was the high in the calf price. So the last bar on this chart is 2025, and it went lower. The key to watch 2026, when we get that inventory report in January, if that thing ticks higher in 2026, that tells me 2026 will be in the high in the calf price, and it'll be higher than that yellow dot on the chart. We'll be up above $4. Again, we're up 75 bucks a hundredweight this year. So that won't really happen until placements fall and just force the back end of that live cattle futures higher. Mid 2025, yeah, probably into the end of year end here, we start to see that for real. So the reality I've told you here is supplies have been steady. Even production has been steady up until April. Take a look at our weekly beef production. 5% down is a big number. So we went from steady beef production January through May. We're now running 5% below a year ago. If we go into 2026 producing 5% less beef in America, it's going to get tight, much tighter than it is now. And the question is, ultimately, are Americans done with expensive beef? How much can they pay? Look at that chart on the left. We're $8.63 a pound. 2012, we were $4.75. Pre-COVID, we were $6. We're $8.63. I'm telling you, do not get between Americans and their beef. I don't know how to explain it. Demand is phenomenal. These beef prices today are 51% higher than they were pre-COVID. The 4-year average pre-COVID, 51% higher. And so are consumers just hitting the wall and saying, we just can't pay it? No. At what price do we price them out? You'll know instantly, because that price they're paying every week is the clearing price. This is a sell it or smell it business. And the second they say it's too high, we're not buying it, you're not throwing beef away. You will cut the price and move it. So this is the price that is moving beef every week of the year. And I'm telling you, it's going up. I don't know. I looked at some data on RV sales the other day. You can look at car sales, auto sales, RV sales. U.S. demand is phenomenal right now, not just for beef, and we are nowhere near a recession. We are tight on unemployment. Consumer spending is incredible. I don't know what to tell you other than this economy is still full of money. Don't bet against the American consumer. We still are the biggest consumer base on earth. And for whether it's COVID money, whatever it is, credit, I don't know. People are still spending money. At some point, this will start to bite. It just hasn't yet. And as we tighten those supplies next year, the market raises prices to allocate the scarce resource. I mean, it's crazy for me to say we're going higher on beef, but we're going higher on beef. So think about it from the fast food restaurant side. Put on your McDonald's hat, Burger King, Wendy's, whoever you are. Those fast food companies typically pay about 50 cents over for beef over chicken. 90% lean beef is historically 50 cents more than chicken breasts. Today it's $2.22. That's almost a 5-fold increase. Chicken breasts are now 5 times the price of beef of 90%, or 90% lean is 5 times the price of chicken breast. So what does that mean? If you're a fast food guy, it says bring in the chicken Big Mac, Wendy's, all you see are nuggets. McCrispy strips, they just brought back the chicken wrap. These guys do not want to sell one hamburger this year because they don't make money. Hamburger does not make money in the fast food space, and yet 90% lean, $4.22 a pound this week, record high. It's going higher. We just turned off Brazil. Our cow kill is going to drop. We are going to raise the price of 90s. And what happens? Ultimately, chicken prices rise with it. But for right now, that thing is so far out of whack. These guys will do anything to get consumers to pick chicken over beef this year just because they cannot make money selling beef. So the big piece of that fast food beef complex is imports. And you can see there, 2010, we were 2 billion pounds. Today, we're 4.7. We are going up quickly on imports. And that is the market. That's record high 90s is scouring the world saying, we don't have enough beef. And I know as a producer, you hate imports. And I'm a cattle producer, and it's easy to hate imports. It is your competition. But after 20 years of doing this, I have traveled the world. I've seen beef all over the world. I understand how this works. Imports maybe aren't the big boogeyman that you think. And honestly, if we're honest, imports probably take more market share from U.S. chicken than they do from U.S. beef. Imports are the lowest value product we have. We're exporting short ribs. We're selling ribeyes at $18 a pound. We're backfilling with this cheap grinding beef that competes with chicken breasts. Now, where it does hit you is on your cold cow prices. So I went and ran some data, and I'm not defending imports. I mean, I think we got to be careful about imports, especially over disease issues. But the economics are this. When our cold cow prices are cheap, we don't bring in as much imported beef. When cold cow prices go high, we bring in more beef. They're positively correlated. 0.77 is the correlation. So higher cold cow prices bring in more beef and vice versa. It isn't that beef overwhelms the market and drops your cold cow price. Usually when cold cow prices drop, imports are also dropping. So you can hate on imports, and I love to hate on imports as a cattle producer. It's hard to hate on imports when your cold cows are bringing $1.50 a pound. Pretty incredible. So how fast can a rebuild occur? We saw 2014-15, it happened quick, right? That thing was a flash in the pan and it was over. And the key things to remember, markets are like airplanes. What I mean by that, we haven't left one up there yet, right? Every airplane that takes off lands. Takeoffs are optional, landings are mandatory with airplanes. And they are with markets too. This market will cycle. We're not going to be up here forever. But this liquidation has been extended by drought. We have cut this herd deeply, way deeper than we did in 14-15. We don't have as many heifers as we had. It's hard to throw a whole bunch of heifers at this market. We just don't have as many. And I talked about higher interest rates, higher land costs, age of producers. All these things may have an impact that dampen this cycle a little bit. It may extend the cycle a little longer and a little further, but eventually it will correct. Now that recent prices have been demand driven, we are going supply driven. What happens as this cycle turns? 2026 are your tightest supplies, highest prices. 27, 28, prices begin moderating. 29 and 30, those heifers that were capped are now producing more beef. Prices start to fall. 30, 32, liquidation begins. 32, 34, liquidation ends and the roller coaster starts again. That's what history would tell us. If we follow a cattle cycle, that's what history tells us. Again, I don't know how high and how far, but that's kind of a general expectation. There's going to be a day these prices aren't going to be here, and you kind of got to prepare for that day. Put some money in the bank. So on the other side of this cycle, what happens? Take a look at the left side of this chart, 15, 16, 17. Those are all 10% corrections since January 2015. There's a time to be careful, right? And honestly, it's probably now. This market, I've told you it's going higher. I'm not psychic. There's a lot of things happen in these markets. And I was just talking to Joe this morning, and I said, Joe, Every time it feels like in these cattle markets, when you're just teed up for a home run, it feels like something just comes out of left field and finds a way to wreck that market and just take it away from you. Now, I think the odds are less than they have been in the past, but I mean, you've got wild card events. You've got high path avian influenza in dairy cattle. You know, some dairy cattle worker dies of HPAI. It may set back the cattle markets. We may have screwworm in America in the next 6 months. And I'll talk about what that means. Doesn't matter what it means. It matters what consumers think about it. I mean, you can go wild card black swan. Trump just gave the biggest nuclear dictator in the world, Vladimir Putin, 12 days to end the war. That's what he said this week. He's poking the bear, right? This guy has more nukes than anybody in the world, and Trump's going, it's done. You got to get this over with. There's just a lot of instability. And we know that nothing is certain in this market. And so you look at those 10% corrections. Easy math, what's 10% off a $2,100 steer? $210 a head. Think about it. If you're putting cattle on feed and you go out there and you say, okay, I'm going to put these cattle on, I'm going to go put in a hedge, what can margin do to you at these price levels? If this market sets back, you've got a bunch of cattle on feed in a position, I guarantee you that margin can eat your lunch. So what is your risk management plan? I think they're going to talk about LRP today. That LRP is a no-brainer, in my opinion. If you have cattle on feed and you go and lock your price and leave that upside open, why would you not use LRP? It's a subsidized put. The market's giving you money to do it. You can sleep at night. You can lock up your downside risk. I don't know. Like I say, there are boogeymen under the bed, right? There are things that can happen. I think it's wise to take a careful look and say, one, what could margin do to me if this thing turned? What's my equity? How can I go pull a lot of equity quickly to cover margin calls? It's pretty easy math to go and put on some insurance. All right, let me shift gears and I'll wrap it up here. Everything I've told you is about the US market. Let's look at the global market. For the first time in at least 20 years since I've been doing this, the global cattle cycles are all in sync. The same things happening in Brazil and Australia that are happening here. It's crazy, right? So there's the global beef price index. That sucker's going higher. If you look at the top 8, the global beef cow herd, the top 8 cattle countries, they've been in decline since 2018. Due to weather, due to markets, different scenarios, you got to look at each market differently. But we follow these markets closely. We have a lot of clients in Australia. We have forecasts. We run that market every week. I've got a business partner that lives in Australia. We've got contacts in Brazil. We've been following that market really closely. Brazilian cattle slaughter was up 25% in Q1 from a year ago. 25% more cattle slaughter. What does that tell you in Brazil? They're killing the herd aggressively. Margins are down. They're killing steers, they're killing heifers, trying to make cash flow. And in the next year, we fully expect that Brazilian cattle herd is going to start to rebuild at the same time ours is. They're going to start retaining heifers. In Australia, they finally got rain in southern Australia. They've had good rain in northern Australia. They're in restocking mode. We predict record high cattle prices in Australia by this fall, based on the rebuild. When in Australia, they don't have a lot of hay, they don't have a lot of feed. When they get a drought, they kill cows. And when it rains, they restock. And it is a wild, aggressive curve. They're heading into a restock in Australia. So for Japan, for Korea, for all these global beef buyers, it isn't just US prices going up next year, it's everybody's prices going up next year. And so that really exaggerates the impact of this cycle. 25-26, we'll see the tightest beef supplies and record prices as restocking begins, not just in America, but in Brazil, in Australia, across South America, even Canada. Pretty wild story. Like I say, I've been doing this a long time, and we've been talking about that scenario for 2 years now, watching these going, hey, everything is teeing up to where we're almost in sync in each of these countries. We're now in sync. So exports down 13% this year. Again, that's mainly due to China, Hong Kong. Exports are going to fall next year. As we tighten this market, the US bidder is the highest bidder. The Japanese, the Chinese, they can buy some, but they can't stand toe to toe with Americans. We're going to cut exports as we try to supply this U.S. market. So wild cards, screwworm, right? You've all heard about it. This screwworm problem is an epidemic. It was under control for 50 years in Central America through breeding flies. We have fly facilities, breed millions of flies that cause sterile offspring. For whatever reason, that quit working about 2 years ago. The cases have exploded across Central America. And the problem is, in this part of the world, if you want more money for your cattle, move them north. If you're in Nicaragua, Honduras has a higher price than you. Guatemala has a higher price than Honduras. Mexico has a higher price than Guatemala. And northern Mexico has a higher price than southern Mexico. We all know why, right? The US market is the highest price market. And so there's always this big magnetic pull just pulling cattle north through Central America into Mexico, ultimately into America. That's a big problem with screwworm because these are flies and flies follow cattle. So the control efforts have failed. There's at least 500,000 cattle backlogged in Mexico just thus far this year. By the end of the year, that'll be 1.2 to 1.4. Feedlots are overwhelmed in Mexico. Texas feedlots going empty. Will this reach America? Colin Woodall of NCBA, he goes, yeah. He goes, we fully expect it. Maybe even later this year, we'll have screwworm. I've heard others say the same thing. You can't stop it. So what does that mean? Can we eradicate it? Well, it's complicated. It's a fly. And what it is, it's a fly that lays eggs in wounds of living animals. You guys all know when a cow dies, the flies go lay maggots in that dead carcass. The thing with screwworm, it lays maggots in live carcasses. And so any cow that gets a wound, those flies will lay eggs and that wound will have maggots in, even though the cow's alive. It's a tough thing. Now, we had it in the 1960s and we eradicated it. We have a lot better medicine. We have fly tags. We have so many tools at our disposal. We'll control it. Eradication may be difficult. You have wildlife, you have other things. If we can't get that sterile fly program to work, then that's the best tool we've had. We may have it. Here's the next big question. I know it's all in your minds. Will there be export disruptions? If we get screwworm, does that close our export markets? Not likely. Now, you got to think about this. We inspect animals ahead of slaughter. We inspect for diseases, for lameness, for whatever. These cattle would have to come in with a big wound full of maggots on them and miss the inspector. They'd have to go through the beef packing plant. Somebody'd have to cut and box that wound full of maggots, freeze it, ship it across the ocean. Somehow that gets through the food system, and somehow those frozen maggots come back to life, hatch, and infect a cow in another country. When I say transmission through processed beef is highly unlikely, what I'm saying is it is absolutely impossible. There's no way this goes through beef into another country. Here's the best evidence I have that it won't cause export restrictions. Mexico's still exporting to Japan today. Japan and Korea have not banned Mexico over screwworm outbreaks. So I don't think we see a disruption. There might be a pause. There might be some countries saying, hey, we got to hold off until we understand what's going on. I don't see this thing disrupting exports. However, our live cattle exports will be restricted. We would stop that flow of feeders into Canada and some of those things. So that's a mouthful. I'm going to wind it up here and just go through some of my key thoughts, and then we can open it up, take questions, and get your thoughts. Cattle prices thus far have been demand-driven. This has been a demand-driven market, phenomenal demand. The next 2 years, we're going to see a supply-driven market on top of that. Not only is demand good, we're going to tighten supplies. Higher prices are ahead, likely next spring for the highs. This cattle cycle is alive and well. We just haven't found the right price yet, and we'll get there. Your best investment right now is in productivity. I know what land costs. I know what cattle cost. That's a tough call. And you go buy bred heifers today, they're going to calve next year, and then they're going to calve for the next 7 years through the back end of the cattle cycle. It's too late. The best investment in heifers was the last 3 years. Breed rates, calving rates, wean rates, gains in health. That's where you make your best investment. You do not want to lose one calf. And you don't want one cow to come in open. You want every cow bred, you want every calf. If you have to spend money to do it, you should have the best health protocol you've ever had on your cattle this year and next year, because that's going to make you the money. Now, as I said, high prices equal high risk. Cattle markets are like airplanes, and you have to ask yourself, what is your risk tolerance? And I'm talking about margin calls. I'm talking about the potential of this market to correct, and it will correct eventually. What does a 20% correction look like on your equity line today? If you have a bunch of cattle on feed and you're hedged on those cattle and you get a big break in this market, 20% break, run the numbers and say, can I come up with those kind of margin calls? What is your plan to protect these margins? The market's giving you money to do it. I know you hate to spend money on insurance, but it's nice to be able to sleep at night too. But at these extreme levels, I think it's worth a new look at risk management and kind of what you're doing to protect those margins and what your plan is into the backside of this cycle. With that, I'll go ahead and wrap it up. I'll just tell you, our business, we have a subscription. You're welcome to shoot Sherry an email or me an email. Let me know. We can give you a free trial if you want to get on our services. You can hear me and Simon from Australia talk about these markets every week on our webcast. You can go see a copy of that webcast on YouTube right there. But yeah, feel free, write down my email. Let me know any thoughts, any comments you have, or any follow-up questions. And with that, I'll wrap it up and we'll open it up for questions. So thank you.